Is this Zillow loan program a scam?
They've got 1% as the interest rate and they're contributing 2%. Just for the heck of it, just because they want to be nice, they're going to give you that 2% because the minimum requirement in any program is 3% for conventional. Come on. Where's it come from? It's always going to come from somewhere.
Whoa, hold on. You're telling me Zillow's not giving me that money?
So Zillow's not just coughing up the cash so that we can make a down payment? That's not what's happening here?
Companies like this, they don't make money unless the money comes from somewhere, right? And the consumer's the one who pays it. So let's ask the question, where could it potentially come from? Well, if they're not giving it to you, they're taking it from you. And where are they taking it? Interesting questions, huh?
Hi, and welcome to the Chris and Garry Show. My name is Garry Creath, and I am joined here by my trusty partner, Chris Scott. And we are here to talk about all things real estate. We feel like we have a little bit to contribute here because combined, we have over 50 years of experience in this wonderful real estate space in North America. And today on the Chris and Garry Show, we are joined by a special guest, Jeff Chalmers. Jeff has so much knowledge about the mortgage and lending industry. And in fact, spanning 30 plus years in this industry and over $5 billion in closed transactions, Jeff's epic journey has been anything but boring. I think you're going to learn a little bit about Jeff today, but before we get started, we want to make sure that you like this video, that you comment down below as the comments come up. Make sure you subscribe to our channel so you get updates for further episodes, and make sure you check us out on all the socials at The Paperless Agent. And with that, Chris, let's get started. I want to welcome to the show Jeff Chalmers. Jeff, thank you so much for joining us today. My first question for you, my friend, is this Zillow loan program a scam?
Whoa. Let's be easy with the words here, folks. Scams are awfully, I don't know if I want to be using that one, but let's just talk about this, right? 1%, where's that money coming from? It's got to be coming from somewhere, right? Look, Garry, you and I have had discussions many times in the past about mortgage programs, right? Whether the rate changes or whether down payment changes, it all has to come from somewhere, right? You're doing a 1% financing program. Who's providing the additional money? So as an example, Fannie and Freddie, they allow as little as 3% down. However, those 3% down are usually people who have a much higher credit score. FHA goes to as small as 3.5% down. So there is always these specific requirements. Now, where does 1% come from? So you're talking about the GSEs allowing for a 3% down, and now you get FHA with 3.5% down, VA 0% down. But somehow Zillow's coming up with 1%. Yeah, not buying it.
So let's talk about the details. So Zillow has this new loan program where the buyer can just put 1% down, and Zillow will come in with 2% and contribute that towards the closing costs, right? This is piloted in Arizona right now. Are there any other relevant details to this program in terms of like what it is? Or is that the gist of it?
They've got 1% as the interest rate and they're contributing 2%. Just for the heck of it, just because they want to be nice, they're going to give you that 2% because the minimum requirement in any program is 3%. For conventional, come on. Where's it come from? It's always going to come from somewhere.
Whoa, hold on. You're telling me Zillow's not giving me that money?
So Zillow's not just coughing up the cash so that we can make a down payment? That's not what's happening here? What exactly is going on?
Companies like this, they don't make money unless the money comes from somewhere, right? And the consumer's the one who pays it. So let's ask the question, where could it potentially come from? Well, if they're not giving it to you, they're taking it from you. And where are they taking it? Well, let's talk about what's the interest rate for that program? Why is it only being offered in one state? Interesting questions, huh?
So that's a good question because, interest rates are always fluctuating. Yep. If you were to compare, and I haven't read anything about what their rates are and how they compare to the market. So is that an area where they're basically going to make up for it on the back end with a slightly higher rate to be able to come up with that additional money that then is basically robbing Paul to pay Peter type thing? Is that what's going on here?
Great point. So let's ask this question. In the information and in the articles or city advertising that they provided, they mention anything about rate?
No.
All right. Why is that? I mean, there has to be some form of exception saying, oh, except for this or except for that, or this is subject to. But if they're not providing that information, what is it? The less you provide, the more you're going to pay. I mean, come on. It's got to be, somehow it has to be spelled out as to why they're giving a 1% when nobody else in the country, okay, there are no programs out there that are available that provide this 1%, except for a company. Let me see, what is the name of the company? Oh, Movement. That's right. Movement Mortgage. My company happens to provide something called Boost. And Boost, the information on Boost is very clear, very concise as to how they do it. And it is not a shell game. It is right up front, and this is how we do it, and this is how we make our money.
So, you mentioned shell game. You mentioned shell game. I want to talk about this for a second, because I had this explained to me many, many moons ago. Just before I actually opened up a mortgage bank, and I had it explained, look, you need to understand loans, mortgages, it's all smoke and mirrors. It is a shell game. It's the same money coming from the borrower, and then also same money coming from a bank to be able to manipulate the mortgage into a program that works for both the bank and for the borrower. It seems like there's like this bundle of money that maybe Zillow is able to, move around, manipulate to make it sound like it is this, but in the end, is it all marketing?
Oh, it's all marketing. Yeah. So I'll give an example. So many years ago, they became a product that got invited into the industry, and it was helpful for consumers, called LPMI, right? Lender paid mortgage insurance. Now, the question was, wow, are you telling me I don't need to put down 20%? I can put down 5 or 10% and I don't have to pay any PMI? Yeah, that's the way the program was written. Wait a minute, time out. Let's back up. Money always has to come from somewhere. So where's it coming from? Well, what's the difference between a conventional rate and an LPMI rate? Well, the LPMI rate is higher. Why? Because you have to build in that MI somewhere, right? So you talk about the shell game. There are lenders out there that are providing the necessary information for a consumer to make a conscious, educated decision. And that's unacceptable. Now, there are lenders out there that do the complete opposite. They provide nothing but transparency, and that's the way it should be. Today's industry has drastically changed. You've got a market that has changed to the point where people are struggling. I mean, you're talking about probably 50, 60% of the people in some part of the industry have left. Why have they left? They can't compete. Why? Because there are two types of salespeople: relationship and transactional. Transactional agents, a lot of them aren't around anymore. Why? Because it was all about the money. It was about getting the deals. The people who are relationship-based, right? They're relationship-centric. Those are people who have been in the business and will stay in the business because it's all about building relationships. And that's how the banks created the concept of the mortgage. It gave the ability of a person being able to create their own home ownership where they own something and they had the pride in something that nowadays has dramatically changed. And it's changed in the sense that I'd say home ownership has gone down a bit, but in comparison to years past, where you had to put down a significant amount of money, and they didn't have 30-year mortgages. They had balloons and they were short term. So the idea of the mortgage is a great concept, right? It allows you to buy something that you otherwise wouldn't have been able to. And as the industry has changed and as the history has changed, you find out there are a lot more people who are in positions that they weren't in before, especially financially.
So, going back to that one question, is that loan program a scam? It's not a scam, but it's definitely a marketing play to get consumers' attention. What do you think and would you say that's the whole purpose behind this program, is to get consumer attention? Because, when the marketing looks like Zillow's giving you a gift, right? I only have to put 1% down. You're going to give me 2% to contribute to closing costs? Well, Zillow, you're so awesome. You're my best friend. But that's not really what's happening, right? It's just a marketing play to get the attention. Appears like it's doing a good thing, when in reality it is potato. The money's coming ultimately from the consumer, from the buyer. It's just being spread out differently and contributed differently. But the money is still the money.
Money's still the money. It's got to come from somewhere. So I'll give you an example. History, if anything, teaches us a lot. And one of those things that teaches us is, when markets go on a downturn, something has to change. There's got to be a way to inspire people to get out and to buy. or to refinance. So when you come back to that question, Chris, about look at where's that 1% coming from, that's a great question. But let's talk about this from a common sense standpoint. Where do you think it's coming from? If it's not coming from the consumer, and the GSEs are at a point where they're saying, look, in order to meet our guidelines from a conventional standpoint, you got to meet at least 3%. And if it's FHA, it's got to be at least 3.5%. Where is that other money coming from? Because in order for them to sell that loan on the secondary market, it has to meet those secondary market guidelines. And if it doesn't, that means Zillow's putting it in their own portfolio. And, well, I don't know where their money's coming from, but that's a tough thing to swallow if you can't sell to an investor and get new money.
So where is that money coming from? Ultimately, it is coming from the consumer. Yep. But it's being funneled through the banks, right? So the consumer is going to pay for it one way or the other. And it's going to be either through additional closing costs or higher interest rates or whatever it may be, or mortgage insurance. And then the bank is going to turn around and be able to offer that back to the consumer in a certain manner, and which allows Zillow to then package up these loans and resell them. It's, I mean, it's been happening for eons. This is nothing new, absolutely nothing new. It's just marketing and promotion. And because Zillow's so ginormous, well, they're able to get in front of so many people and make waves where this is not the only loan program out there that is really beneficial.
It's funny, Gary, because many of our listeners and many of the people who follow our show, they're real estate agents, they're real estate brokers, they're in the real estate community. And so as I was listening to you guys talk about this, I was thinking to myself, well, what they're doing is they're advocating for people to go out, buy homes, right? Because in one sense, the norm, people's thinking is, oh, I need to have 20% down, right? Like in standard thinking, most people would assume if you ask Johnny on the street, Kate on the street, hey, how much money do you need to put down on a home? They would probably say, oh, you probably need 20% down. That's what everyone's been told. And, when you go into the details, there are programs, like you just said, there's lots of programs out there that are not 20% down. Most people don't know that. I would say the consumer doesn't really understand that, doesn't know it. Only when they are thinking of buying does it might get presented to them as an option. So this is smart on Zillow's part there, is to go out to, let's say, their customers or to the industry, but we could kind of do the same thing with our customer bases, is to say, hey, did you know you don't need to put 20% down on a home? In fact, I've partnered with a lender who can offer you 3.5% terms. Did you know we can do stuff like that? And so maybe that's a good takeaway, is being able to go to the market and dispel this myth that you don't need 20% down right now. Because right now with higher mortgage rates, people are looking, gosh, the mortgage rates are high and I don't have 20% down anyway. But all of a sudden you remove one of those barriers, right? The 20%. And that's a psychological one, or just a misconception one, because you don't need to have that down. That to me seems like a good way to be able to communicate to people, this is the truth. You don't need 20% down, and at the same time encourage people to explore their options if they were thinking of moving. Do you think that that's like a good idea for, if you're a real estate agent, to go out there and start talking about this with people?
I think that's something that should have been done years ago. But again, there's a difference between a transactional agent or a transactional salesperson and a relationship salesperson. A relationship salesperson, their number one priority is on service, not on sales. And having to do with service means education. You're constantly educating your clients to let them know what the available programs out there. And that's from a loan officer standpoint. If you're an agent, you're constantly letting them know what available programs may be out there for them to buy, what they can do when they're buying it. They can do some type of seller financing, some creative financing. So as an example, with our program with Movement, 3.5%, it's 3.5% down, but that 3.5% down, actually, you can actually do it as a 0% down. And the way it's done is, essentially, it's the way years ago they did it, what they call soft seconds. So you do it as that 3.5% down now is like a second mortgage, right? And then the first mortgage is, conventional, is FHA financing. So you're, again, mandating that 3.5% down, but what great program would you love to have where you can say, look, I don't have the money? Because most people nowadays, to be able to save 3.5% down based on median income, it's going to take them 4 to 5 years at a minimum, right? People don't want to wait, especially in a market that all of a sudden they found the home that they really like. What's the best way for them to buy it? Well, a program that makes sense. Remember, whatever rates that they're basically going to be dealing with right now, that's not saying that those rates will stay around for the next year, 2, 3, 5 years. You know, it provides you the ability of refinancing that. So you're at a higher rate that all of a sudden, in less than 5 years, you're refinancing, and now you're in this home. You built all this equity, and now you've reduced your monthly payment. That's sounds like simple math to me.
So you just brought up a term that I had on my list of things I wanted to ask you about, because the news is touting interest rates are so high, and it freezes buyers from even thinking that they can buy anything. And it makes them actually, you know, more opportunistic in thinking is like, well, I'll just wait until rates come down. Additionally, a lot of real estate agents buy into this as well, because we're watching the national news media as well. We're buying into that hype. And then our buyers come to us and say, well, should I wait? And it's like, well, I would. Why would I go get a loan at 7 or 7.5% right now? You know, as rates climbed up over the last 12 months, we keep hearing this term, you marry the home, but you date the rate. Right. And so can you talk about this? Because I think so many people don't understand that the first loan that you get on your house could absolutely be a very short-term loan, because to your point, we don't know what's going to happen in the next 12 months, 24 months, 36 months. I mean, we have no idea. Can you talk about refinance? What does that look like to a consumer, and how can we as agents educate our clients about, you need to date the rate? Because you're not marrying this rate, you're just dating it until something better comes along.
It perfectly said, Gary. Look at, there's two things that come into play. It's the idea of education and preparation, right? The education side of it is it's explaining to borrowers the position they're in and where they can improve, right? The preparation side is putting yourself in a position so you can improve that. So as an example, in the last several months, I've refinanced a number of people on a rate and term cash out refinance. And why did I do that? Well, the concern that they have is this mentality of, no, look for the low rate. Well, look we're not in a low rates, position right now. But what we are in is a position to say, if I were to improve your bottom line, would it make sense to you? If I said to you, look you've got an interest rate right now of 3.5%, but you've got a car loan at 12, a credit card at 18, and now I'm looking at all your debt. And your total debt may be, let's say, and this is a perfect example of a recent client I did a couple months ago, where their total net, including their housing expenses, credit card, car loans, student loans, I think was like $6,000, right? And that's a month in payments. All of a sudden, you take all that, you roll it into a new mortgage. Now, all the interest that they had before on all that other debt that they couldn't write off because it wasn't business expenses, now all of a sudden, they could write it all off. And now all of a sudden their nut went from $6,000 a month to $3,000 a month. And they're like, I didn't even know this was possible. I'm like, it's about taking a look at the big picture, right? So if I said to you, look, I could save you $3,000 a month, what would you do with the remaining $3,000? There's a lot of things you can do with it. Like, investment based on where you're looking to put it, pay down your mortgage. All of a sudden I'm showing you how to do a 30-year term into a 20-year term or a 15-year term, using the money that you just saved, which means it's not coming out of your pocket. Now, the biggest piece is this. People are like, well, wait a minute. Look, I'm going to wait for rates to drop. Well, wait a minute. If I said to you, you're going to wait for rates to drop back to 3%, but say the interest rate was at 7%. But if I said to you, look, the interest you can write off per year is twice that, would you do it? Well, wait a minute. Are you telling me that I can make a reduction in my taxes? Yes, you can. Should I wait? Should I be in a position to wait for the rates to come down? Well, how many times have you heard from someone in the family, I wish I had, I could have, I would have, should have, right? If you were able to buy that property now and that property gained in equity, let's say 5%, and you bought the property for $600,000, 10% is $60,000. So you're trying to tell me in the course of 1 year, you made $30,000 in equity plus what you paid on the mortgage in equity? If I sat there and say, I'm just going to give you free money, would you take it?
Well, plus the tax savings because of the tax write-off on interest, right? So what I love that you bring in here is the true complexity, but simplicity. So simplicity in the fact that money is not complicated as long as you have a handle on it and you have knowledge about it. And I love how you bring in consumer debt, car loans, any other debt that you have. And that's something that I don't think people think about when all they see is an interest rate of 7%. We'll just make up 7% because things are fluctuating. If I, as a buyer, look and I'm like, man, that's a 7% loan. I don't really want to refinance. I don't really want to buy a new property. And you say, well, you're looking at one factor in your entire financial portfolio. What we need to do as real estate agents is educate our clients that we have a lender partner who can take a real deep dive on your financial situation, run some numbers, and quickly help you make an assessment if now is the right time to buy or not, based on your financial situation, not based on the interest rates. And that also brings back full circle to that whole question is this Zillow home loan program a scam? Well, if we're just looking at that down payment assistance, it would be easy to be skeptical about it, but we're not looking at the full picture. We're not looking at the full loan program. We're not looking at the situation of the home buyer, and we're not looking at the financial overall picture of what this could actually do for somebody. Would you agree with that full assessment?
Gary, you just walked me through to the next topic, which is essentially right. Simplicity creates financial independence. You said it perfectly. Money is not complex. It's quite simple. So let's talk about the idea of investment properties. First and foremost, why would you go buy investment properties? Well, financial independence. If I said to you, look at, how would you like it if someone else paid your mortgage? Would that be cool to you? Of course you'd do that. Now let's ask this question. You buy a property. Let's say you buy $500,000. Let's say it's a 3-unit property, right? You get some nice rents on that. And then in the course of 3 years, that sucker really gained some value. Well, what do you do with it? You cash out. Wait a minute. You can cash out an investment property? Oh, yes, you can. And the cash that you get from that, well, that's not exactly something that you have to show to the government saying, hey, look, this is money that it's shown differently. It's cash out. It's not something that you would have to basically pay because it's not income. So it's seen very differently. And I see people doing this. They cash out of one property. They take that money. They go buy another property. Great, crazy concept that somebody else is paying your mortgage and yet you're getting the benefit of that. It's so vital that relationships be built in a market like this for one simple reason. There are a tremendous amount of agents out there that have a sizable database of clients that they have closed. Well, right now, these clients aren't buying, but they would love to try and reduce their nut, right? Monthly nut. And what's the best way to do it? And I have a number of agents that I work with, and that's what they do. Hey, listen, Jeff, here are the number of clients that I closed in the last couple of years. Right now, it may be a good time for them to save some money because I've gone through programs with them where they can save money, including refinancing these specific partners of mine where they're now saving a ton of money. Because look at, when markets struggle, people end up doing what? They struggle as well. They end up taking out personal loans. They start spiking up their credit cards. It's what happens, right? So when the market gets better, the rates start coming down, guess what they do? All of a sudden they refinance. Well, now is still a great time to refinance on a cash out because it's about saving that monthly debt. And if you're able to do that, and again, simple math. If I said to you, your total nut is $6,000 and I can shave that off by half, would you do it? Well, I'd think about it. You'd think about it? If I were to say to you that extra $3,000 you could use towards X, Y, and Z, one of which may be a vacation, $3,000 a month, 10 months, that's 30 grand. You wouldn't take free money? So right now it comes down to these two simple things, Gary, that you nailed home, and Chris, you've been talking about. It comes down to the relationship side of it, which means you really need to start working with the partners that you're with. There are so many times that I'll see agents' websites and they don't have one piece of information about the people that they partner with when it comes to the mortgage side. Why? Why is that? Do you want to create a relationship with them? Do you want to build business together? And if that mortgage person that you're partnered with has a level of integrity that you can sit there and provide all these clientele to them, but yet you don't want to provide them with additional resources, this is the same mortgage person that is going to build a business back for you, because as that client gets into a better financial position, guess what? They may now be in a position to buy a second home or an investment property. So It's just goes around and around and around. It's all about the relationships.
Everyone in real estate needs to really focus on that, because if you can use tools like this to go out and build those relationships and provide value to them, why wouldn't you, right? And if you could partner with the right people to do it, why wouldn't you? It's much easier to go things, with people together as opposed to trying to be a lone wolf out there and selling real estate. Build a team of not necessarily buyer's agents, but your transaction team might include your lender, right? So all of that is about focusing on the relationship so that we can produce better outcomes.
Two things. One is financial literacy that you just talked about, Chris. The idea that we need to create that brain trust of people, right? That we really can trust, but we're not spending the time to do that. So as an example, I require each one of my partners to meet with me a minimum of 3 months, 3 hours a month. Okay. So that's twice, an hour and a half a piece. And I've had agents sit there and say, well, I'm a little busy. I said, let's do the math. Let's just say you work 50 hours a week. Now multiply that by 4. How many hours is that? I'm asking for 3. And if you don't want to take that time to build it with me, I completely understand it, but this relationship doesn't work. You have to invest in things. The people you invest in you, right? And we can't expect our consumers nowadays to know what they're supposed to know. A typical consumer gets out of high school with 0 financial literacy. So this is what it comes down to. Now, right now is the time where you need to be building your business based on one very simple thing: integrity. But people don't want to do that. There are people in the business that are now out of the business because their whole business was based on how much money they could make from you. Well, I believe that happened in the loan offices back in the 2008, 2009, when they made all that money on subprime. I don't know that there's one of them still out there. Find the people who you can trust. Consumers nowadays are not going online to try and shop. They're now getting back to old school and they're asking friends and family, who do you trust? Don't you want to be that person that gets the referral? I'll give you an example. The relationship Gary and I have had. Gary and I have got to know each other over the years. And because of that, Gary refers me business, and I personally work with Gary. That, if anything, says volumes.
I want everybody to leave here with 3 actionable items that you can do right now. Okay, so number 1, Jeff, you just nailed this. 1, you have to find a great trusted lender partner to work with. Step number 2 is you have to communicate your value in these relationships. Chris and I talk about this ad nauseum, is that we have to offer relevant, valuable real estate information. And guess what? Mortgages and loans, they fall under that. And so how do we do that? 1, through email. We need to send out an e-newsletter to everybody, educating them about what's happening right now and what steps they can take. Number 2, social media posts. My goodness, my database is not that huge, but my social influence and exposure is like 10 times that. So those social media posts. And number 3, shoot some really good video. I would highly recommend you as a real estate agent, after you find that great lender partner, shoot some educational videos with your lender partner that you can post on social media that you can get in front of your clients. Okay, so that's step number 2. Step number 3 is get with your lender partner to offer a mortgage review to anybody who currently owns a home. This is paramount. This is what Jeff is talking about, because until somebody like Jeff, your lender partner, until they have a full financial picture of what is really happening in your clients' lives, this whole, 2% buy down interest rate, 7%, it means nothing until you have a full mortgage review. So those are 3 very solid, actionable items that you as a real estate agent can take right now to offer that value, to build those relationships, and be that trusted advisor that your clients need, especially in this time of uncertainty. So those are 3 seriously actionable steps that you can make. And if you are lost about trying to find a lender partner right now, I know, Jeff, you're licensed in multiple states. Jeff, where are you licensed right now?
I'm licensed in all New England, California, and Florida, and my team is licensed in the remaining 42 states. So we cover all 50.
So, okay, so in any 50 states, Jeff and his team can help you out. If you're interested in reaching out to Jeff, seeing what working with a trusted lender partner looks like, we're going to make sure that we get you his contact information in the comments down below.
And if you like what you heard today, please take a moment to like this video, subscribe to the channel, and we'll see you in the next episode.